I'd just like to introduce myself. I'm Eric Ackroyd. I'm the COO of Alternative Prosperity Advisory and Products, and I'm also a transformation and ownership specialist. A little bit more about Alternative Prosperity. We are known as an advisory firm around transformation and BEE, and we specialize in BEE ownership as well as transformation strategies and different various areas of the scorecard, and also helping companies to maintain and improve their BEE status. The legal standing of the practice note is such that it is indeed legislation. It is a clarification of the existing legislation, and the rules for trusts, broad-based schemes and employee schemes are contained in Annexure 100B, C and D of the codes, of Code Statement 100. And this practice note serves to clarify and reinforce the requirements in order for a trust or a broad-based scheme or employee scheme to be recognized for ownership. The practice note is gazetted under Section 14(2) of the Act, and that particular Act allows the DTIC to gazette guidelines, practice notes, and regulations in order to help with the interpretation and the application of the BEE Act. On the other hand, the BEE Commissioner has issued practice guides that are not legally binding. The BEE Commission also issues explanatory notices, and these are designed to help explain processes and procedures, while the practice guides are designed to be non-binding opinions on interpretations. So if we look at the order of the legislation, we've got the BEE Act. Out of the BEE Act, Section 9(1) are the codes, and then we have Section 14(2), which allows for practice notes that are legally binding, and then the BEE Commissioner is empowered to issue practice guides that are not legally binding. This slide depicts a typical picture where we could have a trust or an employee scheme engaged in a ownership structure. If we look here, we have at the bottom, we've got a company or the measured entity, and that measured entity typically would have its existing or other shareholders that may be non-BEE shareholders, and they would hold shares in the company and they would receive dividends arising from those shares. We could then also have a trust or a non-profit company in which an employee scheme or a broad-based ownership scheme could be housed, and that trust would own shares in a company and in turn would receive dividends. There may also be vendor funding, third-party funding that funded the acquisition of the trust shares, and part of that dividend may be required to settle the debt, the acquisition debt arising from such a transaction. The trust has beneficiaries and it has trustees, and the beneficiaries could be defined by name or class in accordance with the Annex 100 B, C, and D. So a typical setup here would, for instance, be that the company declares a dividend of 100 Rand, the trust settles expenses to the extent of 15 Rands, and 85 Rand is available for distribution. Now that may not all be distributed depending on the requirements of the trust, the capital or the cash flow requirements of the trust. So the trustees would have discretion to say, okay, we're going to only declare 65 of the 85, and we'll retain 20 in order to satisfy any operational requirements. When we look at the company and the company's ownership scorecard, we would, if all the rules for recognition are met and the objectives of the BEE Act are served, we could then recognize voting rights that arise from the trust, and we can recognize economic interest arising from the trust. So economic interest being defined as the right to a dividend or a similar right of ownership. So that's just a bit of background as to a typical structure and the operation of a trust in a shareholding scheme. Looking at the beneficiaries, the practice note is very clear that beneficiaries can be defined by class. They do not need to be individually identified and named. And this is in accordance with the annexures to the Statement 100. Now, defined by class would mean, for instance, that a company could say, fine, in accordance with our trust deed, we define the class of beneficiaries as being Black first-year students doing a BCom degree at the University of Johannesburg. And that would mean that the beneficiaries are defined by class. So specific beneficiaries within there, that class does not need to be defined. So we don't need necessarily each individual named and those are the beneficiaries. But the definition by class is sufficient in order to satisfy the requirements of the code. The B Commissioner has had the view that beneficiaries need to be identifiable and need to be identified by name. So this clarifies the situation that it is not a prerequisite that we can identify individuals. The B Commissioner also had the view that bursaries that are provided through a trust or an employee ownership scheme, rather a broad-based ownership scheme, that is socioeconomic development in nature and not ownership. But the practice note clearly states that where there are Black students that are recipients of bursaries out of a trust or a broad-based scheme or foundation, that would be able to be recognized for ownership. A further stipulation in the trust or in the practice note is that trusts could be evergreen. In other words, if we take the example of the Black students at the University of Johannesburg that are first years and they're doing a BCom, as these students move on to second year, they no longer fall within the definition of that class of beneficiary, but they are also not eligible to getting a capital distribution or a capital payout for the value of any right, because they only have a hope to participate until such time as they are selected by the trustees, and then they would have a vested right. So therefore, if we have a new set of students moving into that class of beneficiary, then they could participate, hopefully, in that particular distribution. And also what that means is that the capital would not be paid out by the trust. So therefore, it would enable an evergreen structure to be in place. A further stipulation is that minors do qualify. So where we, for instance, have a class of beneficiaries stating that the beneficiaries are Black students of high schools in Gauteng, then they would qualify. There has been communication by the B Commissioner that minors don't qualify. So for instance, in a family trust, there were issues where the children were beneficiaries, and the Commissioner had the view that they do not qualify. But this practice note clearly stipulates that minors do in fact qualify. And given the nature of an evergreen structure, as this population moves on, the beneficiaries would change, or the class or the potential participants within that class of beneficiary would change as years go by. The term discretionary collective enterprise refers to that the trustees do have discretion in a sense, but they only have discretion within the boundaries that are created by the trust or the scheme, and they cannot deviate from that trust deed. They need to ensure that they do comply with the requirements and the boundaries set by the trust deed, but within that, they can have discretion as to individuals. An example here would be that the trustee could state that 100% of all distributions will go to school children in Gauteng in high schools, and then therefore they have to comply with that 100%. So they can't go and distribute any of the distributions to another class of beneficiary that is not defined in the trust deed. So the beneficiaries do have the discretion, as mentioned, to select individuals from within that class of beneficiary. And only once those individuals have been selected do they have a vested right to participate in the distribution. In cases, the fiduciaries or the trustees could also decide on the portion that goes to a particular beneficiary once they are selected. And that within this class of beneficiary, but not in terms of the proportion that is allocated by the trust deed to the class of beneficiary. The practice note is also very clear that the trustees would vote on behalf of the participants, and in terms of recognition, they would recognize this not by looking at the trustees, but voting rights would be recognized based on looking at the actual participants in that class. In terms of vesting, the income and the capital vests in the defined class of beneficiary and not in the individual beneficiaries, but rather in that class of beneficiary. The individuals that form part of that class of beneficiary, they do not have a vested right. They only have a hope to participate once the selection has been done. And once they are selected, then they would acquire this vested right to the potential or the distribution that is made. Once that distribution is made, the beneficiaries or the selected beneficiaries then have no further right, but they then have the hope to participate because they form part of the defined class of beneficiary. In terms of distributions, the BEE Commissioner has had a view that distributions in kind cannot be recognized. So where there are distributions and, for instance, the education is paid by the bursary, that in accordance with the BEE Commission's interpretations would not count. However, the practice note has been very clear that these indeed do count, even though they are in kind. And this could be linked to skills development, that could be linked to education, and also to community upliftment intervention or development programs that are for the benefit of participants. So if we look at community upliftment, that could be infrastructural specific to Black people in the community, and that would then be recognized, but it would be recognized based on the proportion of benefit. If there were to be no distribution in a particular year or in 2 years, then it doesn't mean that there is no economic interest. Economic interest is defined as the right to a dividend or a similar right of ownership. And therefore, we look at that right that is in place. We don't look and see, okay, there was no dividends declared, so there's no economic interest. The declaration of dividends and the flow of economic interest is an indicator of the health of a particular scheme, but it does not disqualify an ownership transaction if there is no distribution. And then, as mentioned, the discretion that the trustees have is within the scheme constitution. And in those rules, the scheme should cover both the proportion that needs to be distributed. So if the trustees only distribute 100 Rand out of 200 Rand, the trustee needs to specify what happens to the remainder of the 100 Rand. But the trustees do have discretion within the class of beneficiary as to who the beneficiaries that are selected would be, but they also have the discretion to manage the cash flow of that trust, and any retained income needs to be also declared in accordance with the trust deed at a future date. If we look at how do we recognize these trusts and the broad-based and employee schemes, the rights of ownership that we count on a BEE scorecard must be determined with reference to the proportions that are specified in the trust deed. So for instance, where the trust deed says that 100% of distributions need to go to Black school children in Gauteng, and 30% of that distribution needs to go to Black female students, then we would recognize 100% economic interest and voting rights for Black people, and we would recognize the 30% to Black women. And on the ownership scorecard, we would then count the Black women participation. Very often with these trust deeds, it's very difficult to always maintain that particular distribution proportions, but there could be clauses stating that should there be less than 30% Black women, they need to cumulatively reserve sufficient funds to have 30% cumulatively distributed to Black women. So therefore, the trust deed would then determine what is the proportion of Black ownership that we allocate on the scorecard. So should the trust deed not be clear on these proportions, then an independent competent person's report can be obtained, and the task of that ICPR, we refer to it, would be to go and work out what is the proportion in terms of the benefit that has been distributed to a population, and also for instance, the Black designated group proportion and the Black women proportion that should then be recognized on the scorecard. Even though the voting rights are exercised by the trustees, the scorecard attributed voting rights would be done by looking at the composition of the participants. So it would follow the same recognition that has been given to the economic interest, notwithstanding that the trustees are exercising those votes on behalf or for the benefit of the participants. So what does this mean in terms of the BEE Commission's items and matters that they've been reporting and been concerned with? It doesn't mean that that is void and we need to ignore all of that. It means that certain of the BEE Commission's interpretations have been clarified, and they've been clarified back in line with what the codes are saying in the Annexure 100 B, C, and D. So we need to follow the practice note, but there has indeed been very relevant aspects that have been raised by the BEE Commission. And the BEE Commission has shifted the industry's mindset to firstly look at substance. And is there substance in terms of the beneficiaries? Is this the real scheme? Is there a prospect that these beneficiaries will benefit? And we don't necessarily need to go and identify each beneficiary by name, but we would want to see that there is indeed, in substance, the intention to benefit beneficiaries. The Commissioner's views have also focused on strengthening the governance around trusts and schemes and making sure that there is sufficient independence to this trust and also sufficient independent trustees on the trust to ensure that there is good governance and that the rights of the class of beneficiary is indeed protected and also served. So we need to look at the objectives of the BEE Act, and we need to ensure that any ownership scheme, whether that's a broad-based scheme or employee ownership scheme, that these schemes indeed are aligned to the objectives of the Act, and that they do not seek to undermine the objectives of the Act. And this is something that the BEE Commission has really put on the forefront of recognition and in vetting the quality and the health of ownership schemes. The practice note then also goes to a related topic, but a different topic that is very relevant to listed companies. And this has got to do with the compliance reporting in terms of Section 13G, whereby listed companies need to report on their level of compliance within 45 days, or 3 months rather, within 90 days from the balance sheet date. And the Commission has been emphasizing that companies also need to report on the number of shareholders, the province where shareholders are located, the disability status of shareholders, and the age of shareholders. The Commission has also gone as far as to say that if they can't report on these aspects, then the company is considered to be non-compliant with this reporting obligation. The practice note goes to clarify what is expected, and the practice note is very clear by saying that if you cannot report on the province or the age or the disability of your shareholders, you can't be compelled to do so. And that also doesn't mean that if you can't report on these demographics, that you are non-compliant with the reporting obligation. What the practice note does say is that if you want to count any black shareholding, then you need to be able to verify that shareholding in accordance with the BBBEE codes and the DTI verification manual. And only information that can be recognized, or rather verified, should be recognized on a BEE scorecard. But this requirement is applicable to trusts, broad-based ownership schemes, and employee schemes, but also it states very clearly it is also applicable to any one or more juristic vehicles. So it is not only applicable to employee schemes and broad-based schemes and trusts, but it is also applicable to other intermediate shareholders, where one cannot identify the location of shareholders, the age, and the disability status of shareholders. So in summary, what does all of this mean? It means that we now have clarity on the rules for recognition of trusts, employee schemes, and broad-based schemes. It means that we still need to look at the qualitative aspects and the governance aspects of how are these trusts secured and governed in order to ensure that the benefits indeed do flow to the defined beneficiaries and that the funds are not misappropriated. It also goes to say, fine, let's align this to the objectives of the Act. And that includes the meaningful participation of Black people in shareholding. The normal principles and key measurement principles contained in Code 100, the ownership statement, still applies. So we need to look and see, well, are the voting rights exercisable, or is that impaired or inhibited? Do the participants or the class of beneficiary, do they have a right to a dividend or a similar right of ownership? And interesting here, that would not be a right to capital benefit, that the right to the capital vests in the class of beneficiary within the trust. So therefore, the evergreen structures are allowed, and we can still then recognize economic interest. And then the net value calculation that needs to be done with reference to any outstanding acquisition debt at the trust level and not at the beneficiary level. So we need to be aware of fronting risks. We need to make sure that there is no fronting risk when we look at the definition of fronting. And the Minister has been very clear that he is appointing a panel that would look at ways how to strengthen the governance and the corporate governance around these trusts, and that he would want to make similar provisions in the legislation in order to ensure that trusts and broad-based schemes are not abused in terms of their objectives. Just before we go to Q&A, I just want to run through the Annexure 100B, C, and D, and we may be familiar with these, but these are the rules for recognition of a trust. And the rule is very clear that the trust deed must define the beneficiary as well as their proportion of their entitlement to receive distributions. So in this case, it could be that the beneficiaries are identified by a defined class of beneficiary, and the proportion could also be attached to that defined class of beneficiary. So that could be a fixed percentage. For instance, 100% of benefits will go to the defined class of beneficiary, or there could be a methodology or a formula that is used to calculate the proportional benefit. So what we would often see in an employee ownership scheme is that in terms of the rules of the scheme, that there is a formula to be applied. And when that formula is applied, there would be the proportional benefit that can be distributed to each beneficiary within that class of beneficiary. And in such case, the trustees would not have any discretion as to that. Upon winding up of the trust, any accrued or accumulated benefits, economic interest, must either be transferred to an entity that represents the interest of these participants, or it's got to be declared and sent through to the actual beneficiaries themselves and distributed. So this clause around the winding up and the accumulation of benefits, that determines that the growth in capital value accrues to the defined class of beneficiary. And the only way that can be unlocked or distributed is through distribution to the defined class of beneficiaries and the selected beneficiaries within that class. So therefore, there can be no leakage outside of the defined beneficiaries. There are also additional qualification criteria for trust. The first being that the trust must be created for a legitimate commercial reason that must be fully disclosed. And secondly, the terms of the trust must not seek to circumvent the provisions of the code. And therefore, it should be aligned to the objectives of the code. So these are the requirements for a trust. Very often, an employee scheme or a broad-based scheme are housed within a trust, and we need to make sure that we for good measure, comply with both the rules of the trust as well as the rules for an employee scheme or broad-based scheme. So looking at a broad-based ownership scheme or a foundation, the management fees cannot exceed 15% of the total income of the trust, and the scheme needs to record the method or the portion of economic interest that is received and the proportion that is reserved. So it must state, if I receive 100, what happens to the portion that I do not distribute? It needs to say, fine, the portion that's not distributed will also go to beneficiaries in the proportion as determined by the trustee. Once again, we can see here that we could have the names of beneficiaries, or we could have them as a defined class of beneficiaries. Once again, either a fixed percentage of proportion or a formula that would define what proportion the distributions are made. And the beneficiaries, or rather the trustees, cannot have discretion as to the class of beneficiaries or this proportion that is specified in the trust. They can, however, have discretion within the boundaries of the class of beneficiaries and the proportion. When we look at further governance aspects on broad-based schemes, it's stated that at least 85% of the value of benefits must accrue to Black people. And in terms of governance, it's stating that at least 50% of fiduciaries must be independent, and also 50% of the fiduciaries must be Black people and 25% Black women. So this is all geared towards ensuring good governance in a scheme. The statement goes further to specify that the chairperson of the Board of Trustees needs to be independent. And then also the clause around winding up. And interestingly, on the broad-based schemes, the economic interest can either be transferred to beneficiaries or an entity with similar objectives. So this also indicates the evergreen type of structure whereby you can move the money upon winding up to a scheme that has similar objectives. The additional criteria that needs to be satisfied in order to recognize 100% of a broad-based scheme is that there needs to be a track record or evidence of capability that demonstrate that they have the operational capacity to operate as a broad-based scheme. And this could be evidenced through a suitable number and a suitable qualification of staff and their experience, as well as in cases premises showing that they are indeed capable of operating. In terms of the rules for employee schemes, there are a few additional requirements on these. There's the usual definition by class and the formula or fixed percentage for proportion. And the trustees do not have any discretion around class or proportion. There are further requirements whereby at least 50% of the trustees need to be elected by beneficiaries or participants, or rather that they take part in the election of 50% of the trustees. The scheme needs to be managed on a similar basis as shareholders of a company would manage a scheme. So therefore, the employees need to be seen as shareholders, or they should play a similar role to which shareholders would normally have with a company. A further requirement is that the trust deed and other statutory documents need to be available to participants in their official language that they prefer, and also that the economic interest of the scheme needs to be paid out to the participants. Now, participants, we also talk about beneficiaries, the same meaning, either at winding up or before winding up. And then there's a requirement that the financial statements of the scheme are presented at an AGM to all the participants. In terms of additional qualification criteria, also the track record is operating as an employee scheme, and then also the requirement that it can be evidence that there is sufficient operational capacity. All right, so Sean, I'm not sure if there are a couple of questions that have come through, if we could maybe go through the questions.
Sure, Eric. Good morning, everyone. So Eric, here we've got a question here. I'm going to read it to you quickly. What is the role of the BE practitioner now that we have some clarity? In the past, her opinions seem to have been at odds with what BE legislation provides.
Okay, so what is the role of the BE commissioner?
The practitioner.
Yeah, I think just read the full sentence for me.
What is the role of the BE practitioner now that we have some clarity? In the past, her opinions seem to have been at odds with what BE legislation provides. So it seems like the commissioner, yeah.
Yeah, I think we're talking about the commissioner. The commissioner's role is exactly what it has been to date. So the commissioner, any transaction, major BE transaction with a value of above 25 million still needs to be registered with the BE Commission, and the BE Commission will still review these transactions, and they will review the trust deeds, they will review the MOIs and the shareholders agreements, and they will measure these transactions as to their compliance, one, with the codes, two, with the practice note, and also whether it's aligned to the objectives of the BE Act, and that there is indeed meaningful participation of Black people. So the BE Commissioner's role would not really change. The further aspect of their role is around the compliance reporting by listed companies. So that compliance reporting will still happen. What is changing is that the BE Commissioner needs to apply the practice note. So where previously there may be issues with a transaction, for instance, where the beneficiaries were students and they got bursaries, the BE Commissioner can no longer make an issue of that, but the Commissioner would need to comply with the practice note. The further role of the Commissioner is to investigate companies for fronting either in their own accord or following on a complaint or a tip-off. So that role still would take place. I think it's just that the interpretations have been brought back to the legislation, and the BE Commissioner would need to apply this practice note.
All right, thanks, Eric. Next question. Do the members of a BEE scheme need to be 100% Black people? This can be difficult in the context of a broad-based scheme, especially if some beneficiaries are BE trusts themselves.
Yeah, so the beneficiaries don't need to be 100% Black. If we look at the requirements for a broad-based ownership scheme, the scheme rules determine that at least 85% of benefit needs to go to Black people. That caters for non-South Africans and so forth. But in those cases, you can only recognize 85% of the benefit. If we look at an employee scheme, the beneficiaries could be defined as Black people as defined. So in other words, South African citizens that are eligible. And it could state that 60% of the distributed benefits need to go to Black people. And it can be saying that 40% can go to white people. In such case, we would recognize only 60% of the benefit as being Black economic interest. Just another aspect is that the ownership scorecard contains 3 points for a target of 3% of economic interest that is held by broad-based ownership scheme or employee ownership schemes. So if we meet that 85% criteria in the rules of a broad-based scheme, we can then count those points subject to it being at least 3% of the economic interest. But if we don't meet those points, the scheme could still be recognized as a trust, but not under the broad-based ownership scheme 3 allocated points.
All right, next question. When do we expect clarity on the issue of youth ownership? I understand there's also some confusion about whether a measured entity loses youth ownership if the relevant beneficiary is not below 35 at the time of measurement, even if the beneficiary was below 35 at the time of entering into the transaction. Okay,
so this is, let's say, a slightly gray area. I think the first principle is that, and I'm going to take the analogy of a Black new entrant. A Black new entrant is somebody that at the time of entering into the BE transaction had never done a deal of more than 50 million. So that Black new entrant, we specify the nature at the time of the transaction. And if we apply the same rule, then we would recognize somebody as youth if they are under 35 at the time of their transaction. So let's say a year goes by or 2 years go by. Now the Black new entrant has done a deal of 100 million. but we still recognize them as a black new entrant because at the date of the transaction, that person was a black new entrant. Similarly, we can apply that principle to say that at the same time, this person, when they entered into the transaction, was youth, and therefore we can continue counting that person as youth. But that is certainly a grey area, and I think also controversial. So when we look at the different verification agencies, we won't get a consistent practice around that recognition. Now, if that youth, if the person that qualified as youth, as soon as they sell their shares, and let's say it's within 3 years from when they entered into the transaction, we will then no longer recognize that black ownership from that youth. If there is any follow-up question, please post them on the Q&A, just in case I need to elaborate a little bit more on an answer.
Right, next one. If beneficiaries are a class, say black first-year University of Johannesburg students, how does a class participate in appointing the trustees?
Yeah, so that is a good question. What we have seen in cases is that the prior beneficiaries, so when there is a distribution that's being made, those selected beneficiaries then get called to facilitate and make that those elections. So that's one practical way of dealing with it. But with the it's only on employee ownership schemes where the trustees need to participate in the election of trustees. So in that case, it's a slightly more defined audience. And if you can't reach the entire class of beneficiary, then you could look at the selected beneficiaries in the most recent distribution.
All right. Next one. If the BE Commission is reviewing a transaction, can they expect you to prove all ownership up to warm bodies, despite there being validly issued BE certificates at the direct shareholding level? Example, can this extend into and pass the share register of listed entity?
Yeah, so the criteria here is that we need to verify in accordance with the DTI verification manual. So if the procedures have been followed per the DTI verification manual, then that is sufficient evidence for recognition on a BE scorecard, which means that scorecard indeed is valid. The BE Commission can initiate an investigation on their own accord and insist on going beyond that. But that would only mean in cases where there's let's say, suspicion of fronting, that they may initiate a fronting investigation. But in terms of whether the BE certificate is misrepresented, the only burden of required proof are the procedures specified in the DTI verification manual. And for instance, that could end with an affidavit where we've got the 51% black owned qualifying small entity and an affidavit is issued. That would be sufficient evidence as to the black shareholding at that level. And it would not be misrepresentation if someone had validly relied on that affidavit. So I think in short, for scorecard recognition purposes, compliance with the DTI verification manual, should the BE Commissioner investigate and launch the fronting investigation, they may go further in order to investigate any such alleged fronting.
Thank you, Eric. It seems like we've got one more question here. What is the status of once empowered, always empowered, particularly in the light of Burger King transactions prohibition by the
Competition Commission?
Yeah.
So the continued consequence, or once empowered, always empowered, is still in the legislation. So nothing has changed around that. One does, however, need to qualify for the continued recognition. And there are three qualifying criteria. The first is that the shareholder needed to be a shareholder for at least 3 years. The second is that net value must have been created in the hands of that shareholder. And the third requirement is that there must have been an increase in the transformation within the underlying entity. So in other words, their BE rating must have improved over the period that that shareholder was invested. And only in such case can continued consequence be recognized. And there's a quantification formula to quantify how much you can recognize. My understanding with the Burger King situation is that the proposed transaction does not have sufficient black ownership in it, and that the Competition Commission is saying that no, we need that the transaction would result in a dilution of black ownership. It would not serve the B Act objectives, and because of that, we are objecting to the transaction, and we require to have more black ownership in the transaction.
All right, thanks, Eric. That's all the questions I have on my side.
All right. Okay. If there are any further questions, please post them, and we can deal with them. We will then also be distributing the slide pack to SAVCA. They'll distribute it further to you, and then the recording is also available afterwards. So thank you, everybody. If there are no more questions, we've saved a bit of time, so we thank you for your time and for being here. And if there are any further matters, please don't hesitate to make contact in order for us to assist. Thank you very much.
Thanks, everyone. Have a lovely day.